Today's studio hub podcast, of course, the podcast interview today, unlocking UK property opportunities for residents and non-residents. We have helped people all over the world who become successful, those who are living legally in the UK and those who are outside the UK. So today we're going to be listening and hearing from an expert on how residents and non-residents of the UK can access mortgage even without living there. Let them type. So if you are interested in this, type UK. If you are joining us live, you're watching us right now, just type UK. So if you type UK, we'll be able to know that you're with us. Listeners all around the world, viewers, we want you to type UK because that's will show us that you are fully with us. Now, we want to tell you why you should pay attention to what we're discussing today. Because at the end of the day, the biggest mistakes foreign investors make and how to avoid losing millions. What if I told you that you don't need to live in the UK to own profitable UK biggest opportunity property? Most of the luxury property that you watch online, or probably if you have been opportunity to visit high-rise buildings, the rich knows this. The playbook is what we're going to be listening today, and you will hear it from the horse's mouth. Global investors are tapping into this. It's happening right now. And that's why we want you to be part of this wealth building. As of today, the mortgage, some think is impossible for non-residents to access mortgage, while others are quietly building genuine generational wealth. That's what we're talking about today. So welcome to TD Studio Hub podcast, where we break the real estate investment strategies for residents and non-residents. And those who want to go global, create generational wealth. We work with investors all around the globe with our partner in the UK, the MPP. Of course, today we're going to be engaging with him, asking those questions and digging really the stuff. So what are you going to be learning? How non-residents legally access UK mortgage, the strategies investors use beyond just buying houses, and the costly mistakes that make many foreign investors fail. So stay tuned and do not forget to like and share. Without wasting time, I want to introduce our guest, Mr. Andrew Young. Mr. Andrew Young is an MPP Residential UK company. So we want to hear from you, Mr. Andrew Young. Without wasting time, we want to start from the first episode we had with you and we'll continue from there. But today is going to be focusing on the mortgage. And welcome to this episode of today. Merry Christmas to you on behalf of TD here. We're happy to have you around.
No, happy to be here. Happy to be here. Thank you for having me on again. And after this, I will wish you all the best of the festivities ahead, especially as the holidays are coming up. But no, I'm looking forward to today.
Thank you so much. My left is Mary. Mary.
Hello, Mr. Andrew.
Hi,
I'm really
Mary.
happy to have you here because thanks for coming out.
Fantastic. Of course, my second to my left is Mr. Michael. Hi, Mr. Michael, to our viewers.
You're welcome.
Hi, Michael.
You're welcome, Mr. Andrew.
Fantastic. All right. Without wasting time, Mr. Andrew, we want to start today the major shift. What's going on in the real estate lately in the UK? So what's the trend? Have you observed in the UK property markets recently? What's going on?
So, since the last time I was on, what we've noticed is normally, historically, it is a quieter period in terms of property transactions. But what I found this quarter has transactions have actually gone up. So we're doing a lot more deals for investors from all over the world. We've actually had a higher concentration from the African continent. So I've got quite a few now that were from based in the UK or based in Africa or based in America. I've had, and then I've had one based in Asia as well. So investors all over the world, locals are buying up properties. And that's despite all the doom and gloom the media has said before the UK budget on the 26th of November. The budget has actually come up positive and the markets have reacted positively. And this month has been a really good December so far.
So I'm looking at that trend. What can you rate, or can you by percentage of what the Africans investment percentage to the UK real estate?
I can say for me and for the company as a whole, for me it's been 25% of my investors have been from the African continent.
That's awesome. That's very encouraging. That's very encouraging. For Africans and diaspora, those who living in the UK and outside the UK, 25% is the inflow of the Africans to the UK real estate markets. So we will be maybe listening to us here, you can make up the remaining 25%. So by 2026, we should be looking at 50%.
Hope it's looking that way. It's looking
Right.
that way, seriously. Having a lot of serious discussions with people from the African continent, either based in the UK or based in Africa themselves. And we are doing a lot more deals with them. On average, if we look at the past few years, it might have only been like 10%, but it's now more than doubled, especially for myself.
Exactly. Those who are listening right now, people are earning in pounds, British pounds. Coolies, secretly, they don't want you to know. Maybe you live in the UK, they're hiding this. They want you to keep, do not understand how wealth is created. You can earn a piece of real estate in the UK, Manchester, Birmingham, Liverpool, and the rest of them, and the London, metropolitan. So you can earn this thing and begin to build wealth. And that's why we were taking it upon ourselves with the partnership with MPP, Residential UK. We'll be able to show you step by step on how you can start earning, whether you are in Nigeria, in India, in Dubai, in Ghana, Cameroon, Nairobi, so you can earn substantial real estate return on investments. So I want to yield to Mary. Mary, over to you regarding the types of investments those who are listening to us could step into right now. Okay.
Hello, Mr. Andrew. Ever since we've been marketing this UK investment opportunities to Africa and Nigeria, the one of the questions we get the most is people asking about the tax regulations for 2025 stroke 2026. So that brings me to the question that are there new tax regulations that investors must prepare for in 2025, 2026?
So from the budget, the tax regulations have actually affected personal buyers, so people who buy property in their personal names. This has been going on for the last decade with government policy. They want less, what do you call it, mom and pop landlords and more professional landlords in this space. So they've slowly been taxing them out and moving them on to more professional, like more professional landlords. So in terms of taxes, they've only added 2% on rental income,
Yeah.
which for every £1,000 in rental income, that's an extra £20 increase in taxes there. But that's only for personal name. For limited company, there hasn't been, no, there's not much more in terms of it's not changed.
Okay. Any follow up on that?
Yeah, I think that would be all for now.
Okay. So when you say 2%, you said 2%. Or what? Did you say 2%?
Yeah, 2% tax.
Okay. So
increase.
when you say 2%, how does that impact the price of the real estate costs in the market?
So, how that will affect? Well, actually, it's
Yes.
already started. So it's already started to affect rental prices. Rental prices have gone up about
Yes.
I think 1% in October. So they're already pricing in the tax increase in
Yes.
rentals.
Your
And what
voice
that
is very faint. I don't know whether it's coming. Can you hear me loud? Can you
yeah, I
hear
can
me?
hear you.
Okay. Your voice is very faint.
How's my?
Just pause
Is it
for a
better
while
now?
they rectify the. Let's check whether it is from our side here or on your own side.
Is it okay now?
Okay, just 1 second.
Yeah.
So, audience who are watching us, please stay tuned. Do not go away. We want to make sure that you hear what our special guest today from the UK, MPP, representing MPP. MPP has won numerous awards in the UK real estate business for years. They've been top notch, and they're strategically located in Manchester. So Manchester is where they are located. So if you want to visit, you're already in the UK or you are in the Manchester, check out on the bio session our guest today. You'll be able to connect with him and then see that you start your real estate portfolio investment right now, because this, you can see that Africa is also leading in terms of the percentage of the global investment into the UK, 25%. So we want to prepare them more investments coming from Africa to the UK real estate market in 2026. Of course, this is the last month of the year 2025. For those of you who might have missed that particular investment for the 2025, you still have opportunity right now to take advantage of that for the 2026. We trust that after today's podcast, you will be able to have more information regarding that. So that's exactly what we're talking about right now. So make sure you pay attention. Put in the chat box your questions, and we'll be able to put it to our special guests, our expert who's going to be analyzing everything, and then pay attention gradually. We're going to be going to the next question again. We sincerely apologize for having technical glitches, but we are trying to stabilize the network. And thank you for your patience, and thank you, Mr. Andre. Thank you for the attention that you have paid. We're still having not audible. We're not audible. We're not audible. So we want to make sure we're not audible yet. We're not audible. We're not audible yet. All right, please pay attention to what we are talking about today. So we want to make sure we do not have an interruption while we continue with the podcast, and then you will have a very quality audio streaming. And that's exactly what we're trying to rectify right now. So for those who are listening, I know most of you are doing well in the local markets. We want to make sure that you expand your portfolio by earning in foreign currency, which is the pounds, the dollars, and then some of you might have invested with us. We've helped numerous people to build wealth all over the world. We've helped a lot of people, clients whom are already earning return on investments all over the world. So we want to make sure that you will be part of those people who are going to benefit from this in the coming year, 2026. And that's exactly what we're doing right now. Please bear with us while we rectify the technical glitch. Please, people that are listening to us, we are streaming live from a podcast. We have technical glitches. We're trying to resolve it. Please bear with us. Do not go away. That's the point. That's the point. That's the point. That place, that place. Miss Andy, can you hear me now?
Yes.
Oh, fantastic. All right. So we sincerely apologize for those who are watching us right now. So we had a very technical glitches, interferences on our audio recording. So what we could just speak directly to you live. As we were before we get into the interruption, so we were talking about the need for the African investors and those who are living in the UK and those outside the UK, so they could be able right now to tap and jump into the real estate markets of the UK. So, having said that, so when I did ask a follow-up questions regarding the 2%. I said how it's going to affect the cost of the paper investors who are going to be putting in money into the real estate. It's going to make the cost go up, or it's going to, how does it, the negative impact of the 2% increase in tax?
Yes, so with the 2% increase on personal personal rentals, so people who bought in their personal names, it's just going to add £20 tax on every £1,000 in rental income. So it's increased the cost, which reduces the margin, but then investors who own in their personal name will raise rents to cover that extra cost.
Okay. All right. Without wasting time, so Michael, to the top questions that we have today, which our investors are asking, Michael, over to you.
Okay. Thank you very much, Mr. Andrew. And one of the questions our audience have been asking is about the financing and investment and structures. And they want to know that what alternative financing options exist for non-resident who may not qualify for traditional mortgages.
Okay, that's a very good question. So most non-resident investors who at least have a job or an income will qualify for a traditional mortgage, depending on other circumstances as well. But the alternative financing option, which is more costly, but if you can't get a traditional mortgage because I've had a client who was between jobs, so they were moving from one job to another. They might have got a bridging loan, which would cover the completion cost for the time, let's say for 3 months, 6 months, and in some cases up to a year before they can get a mortgage, and they'll use the mortgage to pay off the bridging loan. But that is one of the alternative financing options that exist. So ideally, most of my investors have got traditional mortgages who aren't residents because they have jobs, they have high-paying jobs. In lenders' eyes, they are very safe. But there are a few where clients have had to go to the bridging loan option.
All right, so thank you very much, sir. And to buttress that question, what is the impact of currency exchange rate on international investors? And how can they hedge against currency risk?
So with currency, I think one of the main reasons why the UK has been popular this quarter is because the stability and the strength of the pound sterling compared to, say, other currencies, maybe in the African continent, in the Asian continent, that fluctuate about 5 to 10% on a daily basis. So the value of your money, or how much you can spend in real terms, fluctuates a lot. Where if you invest in the UK market, you are getting pound sterling. It holds its value, so you're not having to consider what that can buy, because it's not changing very much on a daily basis.
Thank you very much, sir. Another question is, can investors pool funds through joint ventures or group investment? I mean, like, can 2 or more people co-invest in one of your off-plan properties, of your off-plan real estate investments?
So can the investors
Co-invest, like a joint venture, like a joint investment?
Yeah. Okay.
Possible.
No, that's a very good question, and that gets asked a lot more than you would think. So, with you can, of course, if say two investors said, "I don't have enough for this property," or "I want to reduce the risk I have," would you like to invest with me? The structure that we have in place in the UK is limited companies. So they can be both shareholder of the company that buys the property. And then there is legal shareholder agreements in place that protect both shareholders. There are legal documents in place to protect the interest of both investors. I would say the maximum you want is two, maybe three, but ideally two. Anything more than that, and relationships, because you're investing in a pool, etc. It might not work out very well, but two is probably the most ideal if you have to invest in joint venture.
Co-invest in one company. Thank you very much.
Okay, so does it have, when they co-invest, maybe two or three? That's husband and wife can do. That's already one. Husband and wife.
Husband and wife would be considered one. I would consider that a joint venture. I would consider husband, because actually a lot of investors are husband and wife.
Yes.
So I would consider that being one investor. They're buying for their own future.
So let me just follow up on that line of questions. So can a non-resident, because those are the questions we also get, and then a legal resident in the UK, residents, what I mean is their legal right to live in the UK, either permanently or the citizens. Can the non-residents who are not legally allowed to live in the UK join together to buy property as an investment property?
Yes, certainly. This year I've had 2 or 3 cases where that has been the case, where one of them is a resident of the UK, but the other is a resident of France, I think, America, and I think one's in Spain. So you can certainly do that, and you can set up a limited company to do that and to protect the investors' assets and investment.
Okay. Is there any situation whereby the client, maybe each party will try to take advantage of the other party, where, because the person is not, because people are watching us right now, but most of them, they are always in their mind is the risk of losing their money. So in case a legal resident person who is a UK citizen decide to, take advantage of his non-legal rights. So what happened in that case situation?
So you have a shareholder agreement. So you'll have an accountant who will document everything, and it's in the accountant's remit to make sure that all shareholders are notified of anything, and that it goes according to the shareholder agreement. And you'll have that when you set up the limited company together. You'll have the accountant, and there won't be any. You won't be able to take advantage legally, if that makes sense. But then again, of course, there's always that worry, and that's a concern. But we have the legal framework in place to mitigate that risk.
Okay, so both the non-residents can invest in the UK property, so
yes,
without having to fear of losing their money.
Yes.
Okay, so could you break down the types of properties currently offering in the best rent to yield performance in the UK property market? And then which is it, in Liverpool, Manchester, Birmingham, or London City? So which one is the best place for those who are watching us right now? So most of them, they have places that might have been dreaming or they have planned to live. So you being an expert in the market, so which property types are currently offering the best rent to yield performance in the UK property market?
So this year, the best performing property at the moment are properties that are slightly lower cost, so they're not in city centre locations. They're outside into regeneration areas, so areas that are being regenerated, not as appealing right now, but they have got a lot of appeal as the regeneration goes on. And that, in terms of price, is a lower entry cost, but with rental as well, is going to give you the much better yield. And we've seen that this year. And
When you say regeneration, for those who are listening, so what do you mean? Can you break it down for the average investors to understand what do you mean by that?
So regeneration area is an area that doesn't have all the transport links, that doesn't have all the niceties of schools or parks or green space, and it might be disused, it might not be well looked after. The council wants to regenerate that area. So they'll put in new schools, they'll put in new infrastructure to make it more appealing to families and young professionals to live and work. So they'll invest in more green space, they'll invest in building more nice residential properties, they'll invest in the areas to attract more higher paid workers to move in.
Okay. So how do infrastructure projects like a project like rail lines and tech hubs, for those regenerational areas? So how does it influence the property appreciation? So, and then also for, I'm also trying to connect this with, we have majority of our people who are living in the UK are studying understudied routes. They're living there with their families. And what do you think? How do you advise? What's your advice, professional advice? Are they allowed for, if you have an understudied permit, and they're allowed to buy property? Are they allowed to invest into the real estate in these areas? And then what are the price variation from the city already developed locations to those areas that the regeneration is taking place? So what our investors and listeners to be able to understand this thing before they get into it.
Yes, so with infrastructure projects, you are improving the accessibility of that area to main working locations, right? And when you're offering quicker commute times, you're making it more appealing to home buyers and renters alike, where the prices might be a little bit lower than prime locations, but because of the new infrastructure project, you've reduced the time. They were often overlooked, but now because they have a new train line or new tram station or new infrastructure in place, that difference is now eroded. So it makes that property and development much more appealing to renters, young professionals. They have higher disposable income. They can afford nicer properties to either rent or to buy to live in, and that will push up pricing as well as rental in the area.
Okay, so I want you to dig more for those who are watching us right now. So today we are talking about how the non-resident and resident UK residents can access UK mortgage. Of course, the strategies of how you could be able to buy, go beyond just buying, but also to avoid the costly mistakes. So what's the mortgage rate right now? Are they the same thing with residents and non-residents?
So mortgage rates for non-residents. Let me just pull up my latest figures for this week, because we do get them on a weekly basis. So for residents, the interest rate on a 5-year fix, you're looking at headline rate of 3.69%.
Okay.
So the headline rate 3.69%. That's if everything is clear. You're in a really good position in terms of financing, etc. But for foreign nationals, you're looking at 4.49%.
Per annum?
So it is a little bit more dear.
Is it per annum? Per year?
4.49%. So that's the rate for foreign buyers, people who are non-residents.
How do the calculation? Is it per year?
So that one is so all the calculation is per year. So they work out on per year. So let's say on £100,000 mortgage, it's £3,600 a year, or £4,500 a year for a non-resident.
Okay.
So
what about that? Go ahead.
So let's say you take in £10,000 a year, just for instance, £10,000 a year in rental. After taking away the mortgage, if you're a resident, that would be £6,500 left. If you're a non-resident, it would be £5,500.
Okay. So
that's the difference.
Right. So any other criteria before they can assess the mortgage? Be it individuals or corporates? And then which one is much quicker, or in terms of the corporate?
If you're a corporate entity, because they look at the property, they also look at the investor. But if you buy in a limited company, this is all what I'm talking about is all corporate rates. So if you're buying a limited company rates.
Okay. So listeners all around the world, so if you own business in Nigeria, in Dubai, in Cameroon, Nairobi, and all Asia countries, India, and the rest of them, Europe, and all around the world. So you have already started the beginning. If you have an established business that has cash flow, and then a very structured business, you can actually invest in the UK real estate. Of course, you heard it from the expert, Mr. Andre, that the corporate is much easier to access the mortgage in the UK. And why did he say so, Mr. Andre, if I may ask, based on what the audience asked here?
Lenders look at the asset. So they look at the value of the asset. They look at the rental income on the asset before agreeing a mortgage. They take less they touch upon less on the investor and more on the asset.
Okay. So for individuals, who are watching right now, so how do they access that? For them.
So with that, they would, let's say, Tochi, you say, Andrew, I want to buy this. My income is in Nigeria. This is what my income is every month. This is what I'm doing every month. Then let's say I want to buy this property. You buy this property with me, you exchange. Now you're looking for a mortgage. Our mortgage brokers will discuss with you your options in terms based on your circumstances, and they will give you a few options to choose from, which would you think that would work best for you. So you have a few options. It's not just from one lender. We don't just work with one lender. Our brokers work with the whole market offering.
All right. So I'm going to be leaving it to Mary now in terms of how the investors, in terms of how many the return on investment, how can investors use rental income strategy like short to let, long let, and the rest of them, rental income, taxes, and wealth creation too. Yeah.
Yeah, it's just like the question is just like you said, like how can our investors use rental income strategies like short lets, long lets, and corporate lets to maximize their return on investment in the UK businesses?
So when I'm having a discussion with, say, an investor, what I'm trying to understand is what their motivation is, what they're trying to achieve. In some cases, the investor is risk adverse. So we would go, okay, just rent out to a normal tenant. You're going to get capital appreciation when you come to refinancing. You'll go get some rental yield. It might not be high, but it's much more safer in terms of you're not for instance, in short lets, you're not having to rely on your property being booked out on the nightly rate. On short lets, you'll be looking to have as many nights of the month booked as possible. So for people who come in to visit Manchester or to watch the football game, they need the place to stay, or they're staying on to visit Manchester for a week, and they might want to stay for a week, etc. You'll be able to charge more. So rather than taking £1,000 in rental, you might be taking £2,000 in that month because you let it out for 20 days. Right. And then for corporate,
Go ahead.
And then for corporate lets, people who are coming to visit Manchester for business, they might be looking to book 2 weeks, 3 weeks, depending on how long they need to stay there for work. So you might get like 2,500, 2,700. So, but how many corporate lets would you be able to get in a year? That depends on a mixture of strategies between short lets, corporate lets, and if you're very risk averse, long lets. So short lets and corporate lets will give you the maximum ROI as long as you're happy with the risk involved. And long lets will be much more for the risk adverse investors who are happy with a lower ROI but for more stable income.
Okay. For the period where there are no their properties are not rated, so what happens? Do you guys pay them?
So what we do is we make sure the property is attractive on short lets and corporate lets, attractive for people looking to stay. And this is why we focus on the more luxury end because you can charge a higher nightly rate. We look at area. So when we do offer something on a short let, there is a strong demand for that. People can make 12% ROI on an 80% occupancy in that area. Looking at 14 to 15%. So we've done all the due diligence to make sure that it will be rented out the majority of the time. And that's based on performance that we can see right now. But with any investment, past performance doesn't indicate what future performance would be like.
Okay, so Michael, over to you. So what would you say is, over to you, Michael.
Okay, for someone who wants to start his or UK investment journey, what should that person do? For example, he wants to start in the next 24 to 48 hours. What should the person do?
So if they want to start investment journey within the next 24 to 48 hours is ideally book a call in with me. We'll have a consultation call. It's a non-obligation. You're not obligated to buy anything off me, but it helps me understand their circumstances, their needs, etc. And if they want to prepare something before contacting me. I just need to know how much they're looking to invest, when are they looking to invest, and what their motivation is. Why are they investing? And that's all I need to see if I can help them.
All right. As we're wrapping up today's podcast, we're looking at this exit strategy and, of course, portfolio expansion. So, how can investors identify the right time to exit or refinance UK property?
So, with any of my investors, I tend to advise them not to exit, just to hold for as long as possible.
Why did you do that?
Because when you refinance, you'll be able to pull out the capital appreciation.
Yeah.
As that is taken on as debt, a lot of my investors aren't paying corporation tax or capital gains tax or anything like that. But they've still got a rental yield. So they can benefit from the capital appreciation by refinancing without having to sell the property.
Can you break it down a little bit? Because this is where the main thing happens, which a lot of unfortunately, most of our people who are not knowledgeable in the real estate building, real estate portfolio, do not understand the refinancing, and then of course capital appreciation and the rest of them. So could you break it down to the person watching right now who tend to get into this call with you?
Yes, so let's say you bought, I'll try and make it as simple as possible. Let's say you bought a property at £100,000.
Okay.
Right. Then you've put down 25%. So £25,000 is what you've invested as a deposit in that property.
Okay.
In 5 years' time, let's say it's £150,000. So you've already got £75,000 in equity because it's grown by £50,000. You've got a £75,000 loan, mortgage, and then you've got the 25%. So the £25,000 plus the £50,000 growth, that's your equity now. So from 25,000 to 75,000, that's your equity. And then that means your equity there is half. So the loan is £75,000, which is half the value of the £150,000. And for a 75 loan to value ratio, as long as you have 25% equity in there, you can pull out the rest. So 25% of £150,000 is £37,500. And then let's say your equity is £75,000. Now, minus £37,000, you could pull out £37,500 for mortgage. So rather than having a £75,000 mortgage, you now have £37,500 in your bank to invest, but your mortgage now is £112,500. So you've benefited from the capital appreciation, but you're not paying any corporation tax on that profit or anything like that by selling the property. So you can still get a rental yield, but you've taken out equity in that property to invest in other properties. And that's what I mean by is much more smarter to refinance than it is to sell the property.
Okay, so in that case, the money on the loan, you're not being taxed on that. Is that correct?
No, because it's a debt.
It's a debt. Okay, so that's where the game the playbook is important because most people do not. That is that where the rich make getting richer and the poor are getting poorer.
Yeah, so they still have a property that's still growing in value. They still have rental yield from it, and they've pulled out £37,500 from that property, and they use that to buy another property, and then they repeat and repeat and repeat.
So this is where the wealth is growing. Those who are watching us today, you can see how the journey is all started. They will not play this for you to understand it, because once you understand it, the rich and the wealthy become irrelevant because you will not depend on them. You will play the secrets and the game. That's where the game is on. This refinancing is where the rich are getting richer on a daily basis. And that's why you should subscribe to this platform, the TED Studio Hub, because we will be bringing Mr. Andre on frequently, and then he will be giving us the secrets, these codes that will help you to build exponential wealth and gradual from step by step. And that's why we are doing this. Please make sure you subscribe, make sure you send your questions. We are here to address them. So just like we have all said, we know that it's possible for non-residents to be able to access the mortgage of the UK. We now understood it based on the expert. And then just like my colleague asked, what do you have right now? What's the minimum you have right now for the average investors? And then do you have for the big boys that anybody can jump into right now before it closes?
Yeah, so I have a opportunity for short lets in the Trafford area. You only need 20%, and the minimum that is, you're looking at £38,000 required. So 38,000 initial.
Right. Okay, go ahead.
That's all you would need for the initial deposit, and then the rest is on completion, which is a benefit of off plan, especially if you've got cash coming in the future to help you with completion costs.
Okay, so how many years?
2 years. No, not even that now. 18 months now.
Okay. So what I mean is the mortgage year. How many years?
Mortgage. So normally you'll get a 25-year term mortgage, but the rate is fixed for 5 years. So I would recommend people go for 5-year fixed mortgages. For non-domestic buyers, it's fixed for 1 year. And then you can refinance after a year, etc., and then continue to refinance if you need to. But for residents, it's 5 years or 2 years, depending on what you prefer.
So in that case, so they could be able to lock it in for 5 years. So after 5 years, what happens?
It's on the variable rate. So the rate is not fixed anymore. It just fluctuates with the market.
Based in market, okay, the market. So
the interest rate is market rate rather than being fixed for a term.
So if it goes down, what happens?
It could go down, it could go up as well. So that's why people tend to, let's say the 5-year fix is expiring, they refinance, they revalue the property, they pull out equity and get a new rate for the next 5 years.
Oh, fantastic. So those who are watching right now, Mr. Andre, so Trafford, right? Trafford area is available right now. And it's £38,000. And then anybody watching us right now with that £8,000, you get it locked in. How many bedroom?
So £38,000 would get you a 20% equity in a 1-bedroom.
1 bedroom. Okay, now what's the rental value of that Trafford area?
So if you're looking to rent out on the long term, that's £13,000 a year. And on the short lets, corporate lets, you're looking at £29,000 a year.
That's not too bad. Okay, so with this, we want to make sure. Do you guys have any other thing, or should we just have any follow up with some?
I only have not a question though. Well,
Okay.
Mr. Andrew, can you please talk about the investment opportunities that you have, like property investment opportunities that are available right now
All right.
for people to jump into?
Okay. So, what investment? So, your question is what I have right now,
Yes,
or so I
properties
have
that
the
are
one I've
available
just mentioned there right
right
now. I also have developments in city centre locations when we talk about values. Let's say Manchester. City centre, one bedroom, you're looking at £330,000, around that now. With investors this year, they moved outwards of the city because one bedrooms could be had for £200,000, £190,000, which, being 15 minutes from the city centre, that's a large difference in price. That's over £100,000 difference in price. So we do both because both assets offer different results. City centre ones, they will keep on going premium. They'll give you the capital appreciation. They give you high rentals. In terms of rental yield, though, because of the higher cost, the yield might be lower, but you do get more for your money in terms of what you actually see in your bank account.
Fantastic. Those who are watching right now, so you have something in Birmingham, you have also in the Liverpool, and then of
We have
course Manchester.
Liverpool, Manchester. We also have London as well. These are the main locations we're focusing on at the minute.
Right. So those who are listening right now, so whether you are a student, non-resident in the UK, you have equal opportunity to invest and earn income from the UK real estate. And of course, you heard from him the mortgage period, 25 years. Could it be going to be more?
Um,
Mortgage. It's going to be
yes, so with some investors nowadays, that some of them have got 35-year terms. But it
35.
depends on the age. Yeah, it also depends on the age. If you're really young, they'll probably give you 35-year terms, but the majority are 25 years.
Okay, and you guys can help to source for it, or someone can source for the mortgage.
Yes,
Company.
we work with partners who help all of my clients access lenders that the normal high street can't access.
Fantastic. Mr. Andre, how would they reach you for those who are watching right now?
You can reach me on my email,
Yeah.
or if I can put my number down in the
Right.
comments, so that you can reach me on WhatsApp as well. Just let me know where you've come from, that you've come from TD Studio Hub, and then I know where where you've come from and what you're looking to achieve. But if you email me or contact me on my number, that would be the best way to find me.
Fantastic. Thank you, Ms. Andre. We really appreciate all the time joining us for viewers around the world, those who are listening and who are following us on YouTube. Please drop your questions. Some of you have asked questions which we have addressed through our experts here. The UK real estate market is open to its global access. You can access the mortgage like you hear this day. And of course, if you need help, we are available to help you, connect you with Mr. Andre. That's why we're doing this. And then you can chat with us, drop your questions, email, reach us, subscribe to our YouTube channel, and we will be bringing you all the real estate property opportunities in the UK for you to invest, for you to live if you want to live, or you're already in the UK, especially those who are studying. You can actually build your wealth through real estate by buying and pay down as low as 20% and spread the rest for the 25 years to 35 years. Again, it depends on their age and their financial circumstances. So we want to thank you, Mr. Andre, for MPP. We wish you a Merry Christmas in advance and a Happy New Year. We hope to have you again on or before the year, or if not, the early next year is going to be loaded. Those that are watching us, subscribe, because we're going to be coming on your way with a lot of important topics, and then offering you solutions and making it simple for you to assess and build real estate portfolio. Do have a wonderful day. And on behalf of us, we want to thank you for subscribing and joining us and watching us till the very end. Thank you.
Thank you very much.
Thank you. No, thank you for having me. Wish you all a Merry Christmas. And
Thank
I
you.
look forward to being on the next one.
Thank you so much. God bless you.
Thank you.